Hello, I'm Hunsley from Livewire Markets, and welcome back to our continuing coverage of the August reporting season. Today, we are sitting down with Craig McNally, the MD and Chief Executive of Ramsay Health Care, to talk through that company's full-year results. Mr. McNally, thank you very much for joining Livewire.
You're welcome, Hans.
Now, you have just released your latest full-year results. What are some of the key takeaways from the numbers from your perspective as the Chief Executive?
I think the important piece is we are continuing to recover from the disruptions from COVID. So we're seeing volume increase. We certainly are addressing that with improved productivity. However, the inflationary environment is obviously putting pressure on the cost base. And so as well as the productivity improvements that we're seeking and the volume growth that is coming through, we need to get the pricing environment to reflect that.
Ms. McNally, you've already mentioned it there, but how much of that COVID-19 pandemic overhang remains in the business?
It's more, there's a little bit of a incremental cost in the businesses, but it's more about the behaviours of the general public and how they're accessing healthcare. So when you look at the attendances for general practice and how that flows through, it's more a systematic issue than just us in isolation.
In these results, you've referred to quite a few macroeconomic headwinds. I think of labour shortages, cost inflation, increased cost of capital, of course. How are you planning to combat those headwinds and improve margins over the coming year?
Yeah, they're all different issues. And so when we look at the workforce issue, we've had a number of strategies in place for the last couple of years, which are both medium and long term in their nature. And we're certainly seeing success in those. And the pressures on healthcare workforce have diminished from the heights of the COVID period, but the longer term issue is how we develop our own and how we bring workforce that's appropriate into the healthcare system. And then when we look at what we're doing around productivity and certainly the business transformation programs that we've undertaken, we've certainly in the process of accelerating those. So that we deliver better patient experience, better clinical outcomes, more efficiency. So the investment you'll see in our presentation, the investment in those has increased significantly.
I'll come to that transformation program in a moment, but I cannot have this interview without asking, that Ramsay has been the subject of private equity interest over the last couple of years. Does this result show shareholders that you've done the right thing by not accepting those takeover offers?
Well, let's be clear on that, Hans. The board did not have an offer to accept at the end of the day. So we had an offer that was a non-binding indicative offer that gave access to diligence, which was granted for a first phase diligence process. Then subsequently, both the original offer and an alternative offer were withdrawn. So the board wasn't left with anything capable of being accepted.
Right, got it, understood. So you've also recently announced to the ASX that you're looking at options for your stake in the Ramsay's Sime Darby healthcare project. Why are you looking at those options?
Principally because there was a lot of interest from the buyer universe in that asset. And remembering it's a joint venture, so we have our partners' consideration to take into account in that. It's a really good business. It's got strong growth. One of the issues we've had over the years with that business is to be able to grow that business significantly by acquisition. The valuation expectations in the Southeast Asian market, much more than we see in other markets. So we've always found it difficult to make a business case stack up on that basis. But there's certainly a lot of interest in that asset. And as I said in today's presentation, we've got moving into the next stage of that formal sale process where parties are being shortlisted for a second phase. But certainly it's still a potential sale and no guarantees on that completing.
Yeah, well, absolutely. You have already mentioned that in the result that there's no guarantees, but you have said as well that you can't rule a sale out. So if you do indeed sell it, where do you want to put that cash to work, or where would you want to put that cash to work?
Oh, that cash will be used to retire debt, and the consequent result is a significant reduction in leverage.
Okay, so if you talk about paying down a lot of debt there, I'm assuming that is one of a major project or initiative that investors can expect moving forward from Ramsay?
Yeah, we anticipate that process will run over the next few months, and hopefully by the time we get to our AGM in November, we've got something more definitive to announce on that process.
You alluded earlier to a business transformation plan that is ongoing. Can you tell me a little bit more about that plan?
Yeah, it's about how we do business as much as anything else, and certainly a key part of that program is the digital and data strategy, and so executing on that transformation. But it's not just a digital and data transformation; it's a whole of business transformation, and how we look at the processes and practices that we have in our business as a starting point, but how we want to be able to engage with patients, the general community, our doctors going forward, how we can improve our clinical outcomes, and certainly how we can take cost out of the business.
All right, understood. Finally, I couldn't help but notice, but the full year dividend, the full year payout there from Ramsay has dropped by nearly 50%. I have to ask, why has the payout been held back?
The dividend, so we put a dividend payout ratio policy in about 12 months ago, maybe 18 months ago, which was 60 to 70% payout ratio. The dividend that we are paying for FY23 is 60% payout ratio, which is at the bottom end of that range. And we thought that was prudent, accommodating the shareholders' interest, but also looking at the way we'd manage leverage in the current market.
Okay, understood. And yeah, you have alluded to it there that you've got that 60 to 70%, if you like, range, and you've paid it at that 60%. So I'm curious about then why you have kept that payout ratio the same, even though we are in an environment where investors are really hungering for more income. Even on the Livewire website, a lot of our readers and viewers do say that investors are looking for more of those dividends. Why did you choose to keep the payout ratio the same this time?
We look at the longer term capital structure for the business and what our investment intentions are back into the business in the future. And so that's the payout ratio that we think is appropriate.
Craig McNally, Ramsay Health Care, MD and CEO. Thanks for joining us.
You're welcome, Hans. Thank you.
And thank you for joining us. Don't forget to catch the rest of the reporting season coverage on the Livewire and Market Index websites. Thanks for watching.